Our next guest is going to be sharing his take on the state of commercial real estate, New York City's post-COVID recovery, and much more. I want to welcome Bill Rudin. He is co-chair of the New York City-based real estate development firm Rudin. And Bill, it's great to see you this morning.
Thanks for having me back, and happy Mother's Day. And
thank you.
Let's go Knicks and Rangers.
There you go.
Yeah, you've got some big teams that are doing very well in the playoffs these days. How's New York City doing? Commercial real estate here. We keep getting differing views on some of these things. What's it look like from your perspective?
Well, first of all, everybody's a little sleepy because the Ranger games keep going into overtime, but it was a great win last night, and looking forward to the Knicks. I think the city in general is doing very, very well. We're seeing significant leasing activity on the commercial side. Year to date, about 10 million square feet of leases, commercial leases have been signed, including Bloomberg LP to sign a 1 million square foot renewal on Lexington Avenue. Palantir took space downtown. Major League Soccer just a few blocks south here in Penn Station area. So there's definitely activity. April's number were like 2.7 million feet of leases. So it's healthy, but what's happening is it's the flight to quality. And we'll talk about the debt markets too, but tenants are gravitating to buildings that have great amenities, have the understanding that the owner can either has the debt already or can refinance the debt and be able to fund the tenant improvements. So there's this tremendous flight to quality. Park Avenue has about below 10% vacancy. We are seeing tremendous activity in that area because JP Morgan's new headquarters is going to open up next year. We just announced with the mayor and Vornado and Citadel a brand new building that's going to be built on 52nd and Park Avenue for Citadel Securities and Citadel company. Ken Griffin is the lead partner. And it's a 1,700,000 foot building. We just started the regulatory approvals to go through the zoning and get the building approved by the city, which will take about a year and a half, and then we'll start building sometime in 26. It's designed by Norman Foster. It's all electric and environmentally friendly, and Citadel is committed to about 800,000 feet of the building. So that's a very exciting component and reaffirms New York City. It's Citadel's New York headquarters, but it will reaffirm New York as the financial capital of the world.
We had Bruce Ratner on about a week and a half ago, and he's a former New York City real estate developer. He's got a little more dour view, and it could be the difference between the A buildings and beyond. But let's listen in to what he had to say just a couple of weeks ago.
Commercial real estate is in terrible trouble. I mean, you'll hear people say it's bottomed out. It's not going to bottom out. When you have vacancy rates in this city of 25% and occupancy rates of almost 50% or less than 50%, it can't recover. And that's because our whole nature of work has changed.
But what do you think about what he's describing, what he's saying?
There's significant vacancies, particularly in the Class B buildings. The overall average vacancy rate is about 21%, but certain segments on like 3rd Avenue have a 30% vacancy. But what we think is going to happen, the legislature and the mayor and the governor passed a couple of weeks ago up in Albany a conversion bill allowing office to residential conversions. And you're already starting to see companies, owners like SL Green has a building on 3rd Avenue looking at possibly converting their buildings, some of their buildings to residential. Was that solve the problem? Definitely not. Do we have a nationwide issue in terms of debt? There's about $1 trillion of debt coming due in 2024. Then in 25 and 26, another $1 trillion. And it's the flight to quality. The buildings that have good leases will be able to get refinanced, albeit at higher costs. Owners may have to put some equity into the buildings. And then you have the distressed buildings, and that's going to have to go through the cycle of foreclosure. And then there's price discovery now. Right up the block here at 15 on Broadway, Upper Broadway, a building just traded for $300 a foot. Lower Manhattan, 222 Broadway.
And that's down from what kind of level?
That's probably down from $600, $700, $800 a foot.
All right, so you're talking 50% haircuts.
At least. Some are even more. I've seen deals in Seattle and California at 60, 70 cents on the dollar. And you'll see that in the city, too. But there's an opportunity at the right price. There's capital out there. There are opportunistic people who see value. The company that bought the building up on Broadway is a company called Yellowstone, not Mr. Cosner and co. But they bought it at $300 a foot. It's a unique opportunity that this company was able to take advantage of.
The Fed keeping rates higher for longer, the idea of these Fed cuts coming off, is that putting pressure on people to finally get to price discovery? Like,
no question about it. But I was very optimistic to hear your previous guest talking about getting down to below 4% interest rates about an hour ago. I was giving him the thumbs up. We're below 450 now. When I was on the show back in September of last year, we were talking about, 4, 5, or 6 rate cuts. Obviously, that conversation, has changed. But, speaking to our lenders, and I just got an email this morning from one of them, he said, we're active, we're busy, people are stepping into the market and trying to lock in their loans. I think maybe they should wait a little bit longer to get the
price discovery was not something you were going to see as long as it looked like the Fed was going to imminently cut rates.
Yes.
Because that offers a lifeline to people. If you wind up with no rate cuts for this year, that kind of forces some action.
Yes, but you're seeing, I just read in Goldman Sachs residential portfolio in San Francisco, about $600 million of debt. They're handing the keys back. So you're going to see that. I don't think it's going to be, a dramatic one-time hit. It's going to be rolling over the next year or two. And as interest rates go down, there's obviously opportunities for people to be able to restructure their loans. You're going to see people restructure their loans. You're going to see loans get defaulted, and you're going to see people step in at the right price to take advantage of the opportunity.
Given the price discovery issues you're raising, one of the big issues in the marketplace right now are funds like BREIT, which is the Blackstone fund, and some of the other semi-liquid funds, and how they value these funds. Given that they effectively are appraised and they're basically taking a carry fee annually on the appraisal. Do you think that the appraised fees these days are accurate?
That's not my area of expertise. I would never bet against Blackstone, and they're one of our major tenants. And I think the redemptions have slowed down significantly. But I'm not an expert on whether those appraisals are accurate or not. I think they have to obviously mark to market at the appropriate time. So I don't know.